Hello and welcome. Let's do a quick review of cash dividends and stock dividends. The first two we're going to go over are for cash dividends. Now there's three important dates for cash dividends, and that is the date of declaration, the date of record, and the date of payment. Technically only the first date, the date of declaration, and the last date, the date of payment, receive a journal entry. So our first date here, the date of declaration, we have on March 5th, Jacqueline Company declaring a 50-cent per share dividend. And at the time, Jacqueline Company has 50,000 shares outstanding. March 5th. So on this date, the company is officially saying that they are going to be giving out a dividend, right? They're not yet paying it. They're just putting it out there. So when they go ahead and they commit to making this dividend, there's two things we have to do. One, we have to record a decrease to retained earnings, because since we are giving out a dividend, we are no longer retaining these particular earnings. So we are decreasing our retained earnings. Keep in mind, retained earnings is a capital account, hence why we are debiting it. And when 50,000 shares outstanding, and we're giving out a 50-cent per share dividend, so $25,000 is the amount of our dividend. For our credit, we are going to record that we owe, but have not, basically we declared, but did not paid. So we owe this cash dividend, and our textbook uses common dividend payable. And this will show that the company owes that cash dividend. Some professors are fine with cash dividend payable. Just check with your professor. Just to be safe, you can always go ahead and use the textbook option just to be safe. On March 19th, we have Jacqueline Company that is paying the dividend declared on March 5th. So first things first, let's start with the paid part. That's the nice, easy part for us. We're paying it. So cash is going down. Then the other side of that would be that common dividend payable account. Again, this might be cash dividend payable depending on your professor. They might prefer for you to be very clear that this is cash, but of course, just always ask just to be safe. That's it for cash dividends. The first date, the date of declaration, and the last date, the date of payment. Those are the ones who are going to receive those journal entries. Again, we're just decreasing our retained earnings, recording that we owe it, recording that we paid it. That's it. Now, stock dividends are fairly similar. They're just a little bit more complicated. So earlier we talked about cash dividends having those three important dates: the date of declaration, the date of record, and the date of payment. Stock dividends are very similar. They have the date of declaration, the date of record, and then the date of distribution. Because remember, we can't pay stock. We distribute shares of stock, right? So on September 2nd, we have Harrison Incorporated declaring a 3% stock dividend. This 3% tells us how many shares they are giving out. At the time of let me fix that. The declaration, Harrison had 200,000 shares of common stock outstanding, and the market price per share was $32 per share. And I just added one more piece of information in there that we're going to need. We also need a par value. So I always recommend, before you kind of dive into the journal entry, let's just find out the number of shares that we're giving. Now, it says here that we have 200,000 shares outstanding. And keep in mind that means we have 200,000 shares in the hands of the shareholders, right? So when we say, hey, we're going to give out a 3% stock dividend, what we're saying is we'll give you 3% of a share for every share that you own. So for these 200,000 shares, that means in all, to all of our shareholders, we're going to be giving out an additional 6,000 shares. Now, when we do our journal entry, though, we can't do this in shares. We have to do it in a monetary unit. So we have to bring this back to dollars. So let's just kind of compare and contrast as we do this first one, right? So first thing is retained earnings. That part stays the same as far as debiting retained earnings. Now, one thing that you might want to keep in mind is that retained earnings, whenever we're declaring a stock dividend, will always be valued at market price. And what I mean by that is those 6,000 shares, we're going to have to multiply that by the current market price of the shares. So 6,000 shares at $32 per share on the market right now. That means that it's $192,000 being debited to retained earnings. The next part of this is this common stock dividend distributable. Right? And it's kind of similar to this common dividend payable, except, and this is important. Common dividend payable is a liability. Common stock dividend distributable isn't a liability because what we're giving out here is ownership. This account down here is an equity account, right? Because eventually this is going to turn into stock. We're not giving up any type of real economic sacrifice with the company. We're giving out more ownership. And when we give out more ownership, that's not us giving out anything related to liabilities. That is an equity issue. So here for common stock dividend distributable, we have 6,000 shares and we're going to value these, remember this, at par. So the 6,000 shares were valued at market price for retained earnings, but at par down here for common stock dividend distributable. And you'll see in the second entry why that's important. And then the last piece here, because obviously they don't equal. Let's find out how off they are. Let's find the difference. 162,000 is missing from our credit side to make debits equal credits. So the account we have to use for this one is our famous paid-in capital in excess of par value common stock. So it's kind of like before when you learned about issuing stock. We would have common stock, then we'd have the paid-in capital that was in excess of the par value. Now, the reason why we have it laid out like this is because later on September 30th, when the company is going to distribute those shares, we are going to take our common stock dividend distributable and distribute it. So here on the date of distribution, let's decrease common stock dividend distributable dividend to show that they are no longer distributable since we're distributing them. And then we will credit common stock for the same amount. And the reason why this setup is so important is because when we have this common stock dividend distributable, we valued this at par. And what did we learn back when we went over stock issuances before? That we always value common stock at par, right? So that means that this last part, we're simply going ahead and converting it into its rightful common stock. And that is it for cash and stock dividends. Take some time to read through your textbook about some of the more advanced scenarios that you might run into, but really this is the major foundation that you really need for dividend journal entries. So keep up the great work. Happy studying.